In many parts of the country, the housing market is frozen as tariffs, a shaky economy, and conflict in the Middle East keep some potential buyers on the sidelines.
Canada's housing market is absolutely collapsing, and some people, they just want their homes to float away because the loss is so bad.
Report shows many people are drowning in debt.
The number of households that will be required to be evicted is a tidal wave.
You have mortgage interest rates that are still high. You have affordability at terrible levels.
Canada's housing market is cracking hard, and for many families, it feels like the ground is being pulled from under their feet. Some homeowners are now looking at losses so painful that selling almost feels impossible. The dream they worked years to build is suddenly turning into a financial trap, and people are scared. Across the country, the housing market is no longer just about affordability. That was the old debate. Now the bigger issue is that the whole system looks like it is slowing down, freezing up, and putting regular Canadians under serious pressure. Families who poured their savings into homes are watching those numbers fall, while mortgage payments, condo fees, taxes, and daily living costs keep climbing. Canada is not dealing with a small correction anymore. This is becoming a serious financial shock for people who believed real estate was the safest move they could make. For years, many were told that housing only goes up. Buy now, wait, build wealth, and relax. But now the bill is showing up, and it is hitting hard. Since the 2022 peak, home prices in some areas have dropped by around 20%. On paper, that may sound like a market statistic, but in real life, that means a family could lose years of savings almost overnight. Imagine buying a home, thinking you were securing your future, only to find out that the value has dropped by hundreds of thousands of dollars. In Toronto, reports of certain townhouses losing around $525,000 in value in just 1 year have shocked many people. That is not just a price drop. That is someone's retirement plan, emergency fund, children's future, and peace of mind taking a massive hit. And the worst part is that many homeowners cannot simply sell and move on. Selling now could lock in a loss so large that it would follow them for years.
As of April 2026, the average 30-year fixed mortgage interest rate is around 6.3%. Now, I want you to compare that to around 3% in 2021 and over 7% in 2023. So yes, rates have come down from their peak, but they're still high enough where it's hurting affordability.
March sales were unchanged month over month and actually down year over year. And they've sort of stopped talking about this idea of pent-up demand. You know, we're not in a recovery, obviously. We're not really in a crash anymore. Prices are trending down, grinding down slowly. We're in a pause with a lot of tension building underneath. And buyers basically seem like they're being sidelined by falling prices, according to TD's most recent forecast. And then obviously just economic uncertainty, job uncertainty, etc. So
this Toronto condo just sold at a massive loss of over $300,000. This two-bedroom condo at 1888 Queen Street East in the Beaches sold back in April of 2022 for nearly $1.5 million. Well, the condo was just sold again in May of this year for nearly $1.2 million, representing a staggering $305,000 loss.
In Vancouver, some condos that once sold above $400,000 are now being reported at losses of more than 20%. In parts of Toronto and Vancouver, some prices have fallen close to 24%. These are not tiny market moves. These are the kind of losses that change family plans, delay retirement, and leave people wondering how they got caught in such a brutal setup. And let's be clear, many of these families were not reckless. They worked, saved, followed the rules, and believed they were making a smart investment. But now, they are stuck watching the market shift against them in real time. The pressure is heavy because even when the value drops, the bills do not disappear. Ontario and British Columbia are feeling some of the worst pain. These were once seen as strong, untouchable markets. Now, many homeowners are learning that even the hottest markets can cool down fast when interest rates, debt, and weak buyer confidence all collide. Ontario and British Columbia were once the powerhouses of Canada's real estate boom, but now they are sitting right at the center of a slow-moving financial mess. For decades, these two provinces helped drive the image that Canadian housing was almost unstoppable. People believed prices would keep climbing, buyers would keep chasing, and homeowners would keep building wealth. But now that confidence is cracking, Calgary, which many people thought had dodged the worst of the madness, is not looking so safe either. The market there is starting to stall. Sellers still want yesterday's prices, but buyers are looking at today's reality and saying, no way. That creates a frozen market where homes sit, deals fall apart, and nobody knows who is supposed to blink first. It is like watching a crash happen in slow motion. Sellers cannot lower prices without taking a painful hit, and buyers cannot jump in because the monthly costs are just too high, so the whole thing gets stuck. Homes do not move, families cannot make plans, and the pressure keeps building quietly behind the scenes. Quebec and Atlantic Canada are holding up a little better for now. Their markets were not pushed as high by speculation, hype, and panic buying. Prices there were more tied to local wages and real demand, so the fall has not been as dramatic. But that does not mean they are safe forever. When a national housing slowdown spreads, the shockwaves do not politely stop at provincial borders. And here is the part that deserves way more attention. Mortgage rates are doing serious damage in the background. The average 30-year fixed rate has been around 6.3% in April 2026, and that number has completely changed the game. A house that looked barely affordable at a lower rate can suddenly become impossible at a higher one. Many homeowners who bought during the low-rate period are now facing a brutal reset. Some people who purchased in 2021.
Roughly 1 million Canadians are renewing their mortgages this year, including Elias Eid. His monthly payments went from $2,000 to $3,600.
I had to double my withdrawal from my RSP to be able just to cover the mortgage and the property taxes. That's how painful it was. But, that's life.
In Toronto, mortgage delinquencies have tripled since 2022. In the GTA, power of sale listings have doubled in just 1 year. In some Ontario suburbs, they now make up 10% of active listings. That used to be close to zero. This isn't a forecast, it's already happening. Here's the trap no one saw coming. Between 2020 and 2021, Canadians flooded into the market. They locked in 5-year mortgages at 2%. Now those loans are hitting renewal. The new rates are 4 to 5%. That shift doesn't increase payments, it detonates budgets.
This is very much a wait and see market, right? They're waiting to see if prices are ever going to go back up, if interest rates are going to come back down, if they're going to have a job in a couple of months, if the trade war is still going to be going on, if oil prices are going to cause massive inflation and keep squeezing the pocketbooks of Canadians and they won't be able to afford a house. There's a lot of things that are preventing people from wanting to pull the trigger on what is the biggest financial investment of most people's lives in Canada.
Are looking at monthly payments that may be around 44% higher than what they first expected. That is a savage jump. Their income did not rise by 44%. Their savings did not magically grow by 44%. But their bills, those kept coming. Groceries cost more. Gas costs more. Insurance, taxes, repairs, and basic living expenses are all squeezing people at the same time. So when the mortgage jumps, it does not happen in a vacuum. It lands right on top of everything else, and families feel trapped. There is also a major lock-in problem freezing the market. Around 68% of Canadian homeowners are reportedly sitting on mortgages below 5%. That means many of them do not want to sell, because selling would force them to buy again at much higher rates. For some, that could mean paying thousands more every month. So sellers stay put, buyers step back, and the market gets colder by the day. So homeowners stay exactly where they are. They hold, they wait, they do not list. And when millions of households make that same move at the same time, the whole housing market starts acting strange. Normal inventory disappears, real movement slows down, and Canada ends up with this awkward standoff between sellers who do not want to accept lower prices and buyers who simply cannot afford to jump in. On the surface, the market may look calm, but underneath, things are getting ugly. Unsold homes are stacking up, especially in the condo sector. In the Greater Toronto area alone, more than 20,000 unsold condo units are reportedly sitting there, waiting for buyers who either cannot qualify for financing or do not want to take the risk in a weakening market. That is where the pressure really starts to show. Developers are stuck with units they cannot move. Money is tied up. New projects are delayed. Construction plans get paused. And even with all that stress, prices still have not fallen enough to bring bargain buyers back in a major way. Sellers are trying to protect yesterday's values, but buyers are looking at today's rates and saying, that math does not work. Toronto's condo market has reportedly hit a 35-year sales low, and that is a serious warning sign. We are talking about transaction levels weaker than anything seen in decades. Canada's biggest city, once treated like a guaranteed real estate machine, is now watching condo sales fall to levels many people never expected to see again. Vancouver is not escaping the pressure either. Unsold condo inventory there has reportedly climbed past 2,500 units, and the number keeps moving in the wrong direction. When developers cannot sell, they cannot easily fund the next project. That means new supply can slow down, even while the country still has a housing shortage.
Ontario just announced a bailout program, selling it as a housing affordability measure. The province launched a $1.3 billion public-private partnership to buy stagnating developer inventory across the Greater Toronto area to convert into rentals. We all know the condo market is dead. We all know
the condominium market is absolutely dead right now.
That sales have stopped.
We're seeing sales have stopped.
CTV's Heather Wright looks into this story for us. Okay. Okay, Heather, is this a doom and gloom scenario?
Well, Sandy, another report underscoring the economic challenges facing Canadians. And while the softening real estate market is good news for first-time home buyers, the declining housing starts in a country that needs more inventory could mean problems down the road. The headwinds facing Canada's economy are being felt by Canada's housing industry as well.
Lauren, we are seeing dark economic clouds gathering when we look right across the board. You were asking about the top issues of concern. Check it out. In the last 4 weeks, jobs in the economy has jumped 6 percentage points as the top national issue of concern. It's at around 23%.
We've seen over the last couple decades, things get harder for young middle-class Canadians, and most of that, not all of that, but most of that is revolving around housing. That we're seeing home ownership rates fall, young people having to live with their parents longer, getting priced out of our big cities. So it's a top of mind concern for us at MMI.
What are you seeing in terms of how Canadians are feeling about the economy overall?
They're starting to feel quite dour about the future prospects for how strong or weak the Canadian economy might be in the next 6 months. In our Bloomberg Nanos tracking, we asked Canadians whether they think the economy will get stronger or weaker in the next 6 months.
It is a wild contradiction. Too many unsold units in one corner, not enough affordable homes in another. This is why the market feels broken on multiple levels at once. Buyers need cheaper homes, sellers need higher prices, developers need sales, renters need relief, banks need payments to keep flowing, but the system is jammed and every group is feeling pressure from a different direction. Then comes the mortgage renewal crisis, the part that could turn this slowdown into something far more serious. Millions of Canadians bought homes during the ultra-low rate years of 2020 and 2021. At the time, the payments looked manageable, the market looked strong. People believed they were making the right move. But now those mortgages are coming up for renewal, and the new numbers are shocking. For some families, monthly payments are jumping by $2,000 or $3,000. In larger loans, the increase can be even higher, sometimes reaching several $1,000s more per month. That is not a small adjustment. That is the kind of payment shock that can shake an entire household. Imagine opening a letter from the bank and realizing your monthly cost is about to jump by an amount bigger than some people's rent. That is not just stressful. That can change every part of a family's life. Vacations disappear, savings get drained, retirement plans get delayed. Some people start using credit cards just to cover basics. And that is where the danger grows fast. Mortgage delinquencies are already rising. In Ontario, 90-day overdue mortgages have reportedly doubled since 2025. That means more people are not just uncomfortable. They are falling behind. Once a household misses payments for that long, catching up becomes extremely difficult, especially when every other cost is rising too. And when missed payments turn into forced sales, the market could face another wave of discounted listings. That can drag nearby home values lower, pushing more owners into negative equity. Then more people feel trapped, more people fall behind, more distressed sales appear. That is how a housing slowdown becomes a deeper cycle, and Canada already looks like it is stepping into that danger zone. The government response has not calmed everyone down either. Billions have been directed toward the housing sector, but many Canadians feel the help is not reaching the families under the most pressure. Instead, some programs appear more focused on developers, large investors, and institutional players. The GTA Rental Conversion Fund is one example people are questioning. A $1.3 billion plan to convert unsold condos into rental units may sound huge at first, but when it reportedly targets only about 2,200 units out of more than 20,000 sitting unsold, many people ask what kind of impact that can really have. That is not a full rescue. To critics, it looks more like a headline-friendly policy than a real fix. Ontario has also announced a public-private partnership framed as an affordability measure. The idea is to buy stalled developer inventory across the Greater Toronto area and convert those units into rentals. On paper, that may help some supply move into the rental market. But the bigger question is impossible to ignore. Who is really being rescued here? Because regular families are still facing massive mortgage renewals, shrinking home equity, rising bills, and limited options. Meanwhile, developers with unsold inventory may receive relief through government-backed programs.
Yeah, look, everyone is out there still arguing about affordability, but the real problem now is that the entire system is starting to stall.
Yeah, we're not just in a housing crisis anymore. We are now in a construction freeze, and CMHC is basically warning that if this continues, we're going to be short millions of homes again, even after everything that's already happened. Canadian home prices and sales have continued to fall for much of the last year in Canada, and the Canadian Real Estate Association has actually downgraded their forecast for the year. This might be one of the most important housing market updates in Canada right now.
These massive global disasters, really, that continue to unfold.
Now the Canadian Real Estate Association downgrading its forecast, predicting sluggish sales for the rest of the year.
That is why many Canadians are frustrated. They see homeowners struggling, renters squeezed, and buyers locked out, while the system seems designed to protect the players who helped build the mess in the first place. The condo market has slowed hard. Sales have dried up. Confidence has been shaken. And now Canada is watching a housing machine that once looked unstoppable start to cough, stall, and expose every weak part hidden inside it. The Build Ontario Fund is now raising some serious eyebrows, especially because it is managed in part by people with deep ties to the banking world. And that makes Canadians ask a very fair question. Who is this money really helping? Is it helping families who are getting crushed by payments? Or is it protecting the same powerful players who had front row seats while this crisis got bigger? When public housing rescue programs are guided by people connected to banks, developers, and big financial institutions, the public deserves clear answers. Taxpayer money should not quietly become a safety net for corporate balance sheets, while regular homeowners are left fighting to keep their homes. These public-private partnerships are being presented as bold solutions, almost like heroic rescue missions. But without full transparency, clear rules, and real results people can measure, they risk becoming expensive political theatre. Canadians do not need another shiny announcement. They need actual relief that reaches real families, not just boardrooms and balance sheets. And the deeper problem is even bigger than today's falling prices. Canada still needs millions of new homes by 2030, according to housing projections. Yet construction is slowing at the exact moment the country needs more supply. Developers are stuck because they cannot sell what they already built. Financing is expensive. Labor costs are high. Approval timelines in cities like Toronto and Vancouver move painfully slow. So now Canada is trapped in a wild contradiction. Homes are too expensive for regular buyers, but the country still does not have enough homes. That is not normal. That is a major policy failure, and it is hitting working people the hardest. Millennials and younger buyers are watching the dream of ownership slip further away. Even if prices fall another 10 or 15%, many first-time buyers still cannot qualify because interest rates are high, wages are not keeping up.
According to the Canada Mortgage and Housing Corporation, there are about 2,500 completed, unabsorbed units sitting empty in Metro Vancouver, double the amount from a year ago.
Those buildings.
Ari Zadegan is a broker that specializes in distressed sales. She says those who bought a condo in the last 5 years and hope to flip it are losing thousands.
The ones that they were only dependent on the flip are the ones that are hurting.
The soft condo market in Toronto could have a long-term impact on housing supply. Fewer people want to invest in pre-construction, a key part of financing, and developers are backing out of projects. Real estate consulting firm Urbanation has tracked 9 canceled projects in Toronto so far this year. For Bazios, he would like to see not only changes to the ways condos are financed, but also to how they're built.
And stop designing these shoeboxes, because nobody wants them.
And mortgage rules are tighter than ever. That means home ownership is slowly becoming something reserved for wealthy families, people with big financial help, or those lucky enough to inherit money. That is not just a housing issue, that is a social crack running straight through the country. When younger Canadians feel locked out of stability, they delay families, delay savings, delay investing, and delay building a future. Over time, that frustration does not just disappear, it grows. Foreign investment is also pulling back. For years, Toronto and Vancouver were seen as safe places for global money. Investors treated Canadian real estate like a golden ticket. But now some are looking elsewhere. The Caribbean, Southeast Asia, and smaller European markets are starting to look more attractive because they may offer better returns and less policy confusion. That matters because foreign capital helped keep Canadian property values high for years. If that support fades, the market loses one of the forces that used to hold prices up during rough periods. Without that safety net, prices could face even more pressure. What Canada is going through right now does not look like a quick dip that magically rebounds in 18 months. The foundation has problems. Rates are still too high for many trapped owners. Government programs look too small or too misdirected to truly move the market. Construction is slowing when it should be speeding up, and mortgage renewals are arriving in waves, pushing more families closer to the edge. The market is not really healing. It is being patched together while the cracks spread wider. For years, Canadians were told real estate was the safest path to wealth. Buy a home, hold it, and watch your future grow. But now many families are sitting in overpriced homes, facing higher payments, shrinking equity, and fewer ways out. And that leaves one huge question hanging over the country. Is this the end of the housing dream for the average Canadian? Or can the government still step in with a real plan before more families get crushed? Drop your thoughts in the comments, because this conversation is far from over. Do you think Canada's housing market can recover? Or are regular buyers being locked out for good? Like this video, share it with someone watching the market closely, and subscribe to Canada Scope for more updates on Canada's economy, housing crisis, and the stories that hit everyday people the hardest. See you in the next video.